All right, today we're diving into a really fascinating company, one that's right at the heart of the entire aerospace industry. It's called Howmet Aerospace, ticker HWM. Now, this is a company that builds some of the most advanced, most critical parts for pretty much every single plane you see in the sky. And by all accounts, it is a nearly perfect industrial machine. But there's a catch, and it's a big one. Its success is chained to partners who are, well, let's just say they're struggling. So that really brings us to the core question for anyone looking at the stock, right? You've got this best-in-class company, it's got a massive runway for growth that stretches out for a decade, but it's stuck operating in an ecosystem that's deeply challenged. So is Howmet Aerospace actually a smart investment for your portfolio? Let's dig in and find out.
So first up, what does Howmet actually do? Well, the best way to think about them is as the invisible backbone of aviation. See, they don't build the planes themselves. They build the highly engineered, totally irreplaceable parts that make those planes fly safely and efficiently. And we're talking about stuff that is absolutely 100% not a commodity.
The company's broken down into four main parts. You've got fastening systems, the nuts and bolts that literally hold the plane together. Then there's engineered structures, which are these huge, complex titanium parts. And they also make forged wheels for big rig trucks. But you can see it right there on the chart. One of these segments just dwarfs all the others. Half, 50% of the entire company's revenue comes from one place, engine products. And that right there is where the story gets really interesting. But before we get to that, we have to talk about something called a competitive moat. You hear this term in investing all the time, and it's just a fancy way of saying what makes a business defensible. For Howmet, this moat is like a fortress. Their technology is just incredibly complex. Every single part requires years of super expensive regulatory certifications. And once a Howmet part is designed into an engine or a plane, the cost and the risk for a company like Boeing to even think about switching to a competitor is just astronomical. It's not going to happen. And if you need proof of just how deep that technological advantage goes, look no further than this. We're talking about nearly 1,300 patents. This is not some simple metal bending shop. No way. This is deep, proprietary science and manufacturing that's been built up over decades, and it is virtually impossible for a newcomer to just show up and replicate it. Okay, so let's zero in on that huge business segment we were talking about. Engine products. If Howmet is a battleship, this is the engine room. It is without a doubt the single most important part of the company, and it's the primary thing driving value for anyone who owns the stock.
First off, just look at the sheer scale. The engine products segment all by itself is a massive business. We're talking $3.7 billion in revenue in fiscal year 2024.
Again, that one segment makes up half of everything Howmet sells. This is where they make the most critical components for jet engines. We're talking about things like turbine blades that have to spin thousands of times a minute in temperatures that would melt most metals. But here is the real kicker, the crucial point for any investor. It's not just big, it's wildly profitable. A 33% adjusted profit margin is absolutely best in class. It's how they turn all that technological leadership into just immense amounts of cash flow. This right here is the source of the company's financial power. All right, so knowing all of that, what's the argument for actually buying the stock? Well, the bull case is really powerful, and it all starts with one simple, absolutely stunning fact about demand. Get this. Boeing and Airbus have a combined order backlog for new planes that would take them more than 15 years to clear at their current pace. For a supplier like Howmet, that is just unheard of. It means they have unprecedented visibility into their demand for well over a decade. It's a huge advantage. And on top of that massive backlog, Howmet has three other powerful forces or tailwinds pushing it forward. First, the aftermarket for spare parts, which is way more profitable, is growing. Second, global defense spending is on the rise, which provides a really stable source of demand. And third, you've got the boom in AI and cloud computing, which is driving huge demand for the industrial gas turbines that power data centers. And Howmet supplies critical parts for those too. These are all separate, really strong growth stories. And to top it all off, the bull case points to a management team that has, by all accounts, executed flawlessly. They've paid down debt, they've invested in growth, and they have been aggressively returning cash to shareholders through massive stock buybacks and dividend hikes over and over. They are doing exactly what investors want to see. So a dominant company, a decade of demand locked in, and great management. Sounds perfect, doesn't it? Well, here's the conflict. That incredible decade of demand is running headfirst into the cold, hard reality of a crippled and struggling supply chain. And this is where the story gets really complicated. Okay, so what's the counter-argument here? What are the bears saying? Well, the bear case isn't really about Howmet itself. It's about the world it's forced to operate in and the major headwinds it's facing that are completely outside of its control. So the number one risk is this. It doesn't matter if you have 15 years of orders on the books if your main customers, Boeing and Airbus, can't actually build the planes. Both of them are struggling mightily with their own production problems, quality control issues, and supply chain bottlenecks. Howmet can be ready to ship all the parts in the world, but if the assembly lines at Boeing are capped or even halted, that growth just doesn't materialize. The second major pillar of the bear case is valuation. In other words, the stock price. The market knows just how good Howmet is, and as a result, it has priced the stock for absolute perfection. If you look at this common valuation metric, you can see investors are paying a huge premium for Howmet compared to its peers. That high price leaves very, very little room for error if those production delays from Boeing and Airbus continue. And on top of all that, investors have to think about a few other risks. The aerospace and trucking industries are cyclical, meaning they get hit hard in a recession. The company is also exposed to volatile prices for key metals like titanium and nickel. And finally, Howmet itself has the challenge of hiring and training literally thousands of new workers to meet the demand that its customers are promising. That's a huge operational lift. So how do we put all this together? It really comes down to a classic dilemma for any investor. How do you weigh a company's internal quality against its external circumstances? Let's just look at the final scorecard side by side. The bull case is crystal clear. You've got a dominant market leader, you've got huge demand visibility, incredible profitability, and fantastic management. The bear case is just as clear. That demand is basically a hostage to its customers' ability to execute, the stock is expensive, and the business is still cyclical and faces real supply chain risks. Ultimately, there's absolutely no question that Howmet has built and perfected its own machine. It is truly a world-class operator. The final question you have to ask yourself as an investor is this: can a perfect machine truly win when its fate is so tightly changed to someone else's imperfect one?